Hello and welcome back. My name's James Marley. I'm a co-founder of Livewire Markets and you're listening to The Rules of Investing. The Rules of Investing gets inside the minds of leading investors, economists and industry experts, and it's brought to you by Livewire Markets. Last episode we spoke with Christopher Joy from Coolabah Capital, who issued a timely warning to investors about the risk of sticky inflation and the impact that could have on the trajectory of interest rates. Today we're going from the macro to the micro with Chris Stott, the CIO and portfolio manager of 1851 Capital. Chris established 1851 in February of 2020, just before COVID hit, following a 12-year stint learning his craft from market masters Jeff Wilson and Matthew Kidman at Wilson Asset Management, where he ultimately held the role of Chief Investment Officer. Stott and his team at 1851 Capital have successfully crossed the perilous chasm for boutique fund managers, having raised enough money to get the business up and running, whilst also beating the fund's Small Ordinaries benchmark. But it hasn't all been plain sailing. The Small Ords Index has had what many professional investors believe is the worst run since the GFC. But it appears that the animal spirits are starting to awaken. And since late October, the Small Ords have entered a bull market. And small caps have also outpaced their large cap brethren over this period after a long period of underperformance. So the question for today is, where to from here? Now remember, if you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so that you don't miss an episode. Or if you're a Livewire subscriber, hit the follow button at the bottom of the wire to be notified when new episodes are available. If you're not a Livewire subscriber yet, head on over to livewiremarkets.com. It's free, easy to register, and you'll get access to insights from the leading investment minds in the country. With that said, let's get on with the show. Chris, welcome back and good to have you on the Rules of Investing.
Thanks, James. Great to be with you.
Now, I must admit, I'd done a little bit of digging around prior to the show and went all the way back to the start of Livewire and was actually able to dig up this little relic, which was the very first episode of Buy, Hold, Sell that we ever produced on Live. I'm just going to play you a little segment here. Tell me if you can recognise these two roosters on the start. Welcome to Buy, Hold, Sell. I'm James Marley. Joining me,
I had a fair bit more hair back then, didn't I?
We're talking IPOs. We're going to take a close look at the new kids on the block. Chris, let's start with you. Dick Smith Holdings. Dick Smith's to sell, James.
Oh, that's good. I said sell on Dick Smith.
Yeah. Well, I actually went and had a look back at that show. So for those of you that are listening to the podcast, we'll put a photo of me and Chris there. Both of us looking suitably 10 years younger. Yeah. But what was interesting was that whilst we might have been looking a bit green, your calls were spot on. The three first stocks we covered in that episode were Dick Smith, Vocation and Vader Group.
Oh,
and
wow. Okay.
To your credit, you put a sell on both Dick Smith and Vocation. And I believe Vader has subsequently left the bourse as well. So shows you some of the perils of IPO investing, I guess.
It does, and certainly that feels like yesterday, that video, James. And I wish I had that amount of hair today, but I don't. That's okay. But yeah, we get some right, we get some wrong. That's the beautiful thing about funds management is it's always something new. A new day brings something new.
Yeah. Well, IPOs aren't absolutely flying off the investment bankers' desks at the moment. But before we dive in, you've been on the Rules of Investing before. It was just after you kicked off 1851 Capital. An interesting story. You basically raised your money, went into the COVID meltdown, which would have probably accounted for some of that hair loss over the years. But
absolutely.
Since we last had you on, what's been keeping you busy? How's it all going?
Look, it's been going great. Thanks, James. So 1851 Capital, for those of you who don't know, it's a small cap focused boutique funds management business. We're in our fifth year now of operation, managing just under $500 million in assets, primarily, as I said, in the Australian small cap market. With a team of four of us, myself, Martin Hickson, as co-founder, fellow portfolio manager. Matt Nicholas joined us a couple of years ago as a senior equity analyst from Credit Suisse, and Marianne Baldock, our chief operating officer. So we are. It's fair to say that almost 5 years has absolutely flown, but we're really enjoying the business, enjoying managing the money on behalf of the 1,000 investors that we've got in that wholesale unit trust structure. So, as I said, James, the beautiful thing about the share market is it always keeps you on your toes. There's always something new being thrown at you every day, and so we're very pleased with where we sit in terms of fifth year operation. We said at the outset, as said, we raised $80 million just into COVID and deployed that capital right at the top of the market, and we felt sick about it. Our first 2 months, we were down 33%, and we looked like we were entering a steep bear market. And we thought, what a great time to launch a business. But in hindsight, we can reflect now and say how lucky we were to have the business in place then, because we were able to print some pretty good performance on the way out of COVID. The market bounce obviously was quite a sharp V shape, to the point where we soft closed the fund at $400 million only after 18 months. And we'd said at the outset that we'd try to do that within 5 years. So to be able to achieve that in 18 months was certainly very pleasing for us. And so the fund today currently remains open to existing investors only, the 1851 Emerging Companies Fund.
My first question was going to be, 4 years in, how would you score where the firm sits today against your own expectations? But it sounds like, you're giving yourself giving the team a 9 out of 10 for where you are. Is that right?
I wouldn't put a number on it. I'm very hard on myself, as people who know me well would know. There's always things you can do better, and we're always striving to get better. We're striving to learn new things. In terms of how the business has played out for us, we're very, very happy, as I said, to be where we are today. Raising money today in current market conditions is a lot more difficult than what it was for us back in late 2020, and particularly in the year of 2021, when markets were certainly rallying quite strongly. But you certainly never rest on your laurels, and the next day is a new day. And so we're highly competitive. We like to win. Pleasingly, we've been able to perform quite strongly over all time periods. We're ahead of the benchmark and continue to rate very, very highly in that top quartile in that Mercer survey which we track, which compares us to a lot of our small cap peers since inception. So pleasingly, that's the history. But we're now focused on what the next 5 years looks like and how we're going to go about it.
Yeah. Well, you built a good track record at Wilson Asset Management. You're building and establishing a track record at 1851 Capital. What do you think are the key ingredients to sustained outperformance?
There's a number of different things there, James. And the one thing about funds management is everybody's got their own investment process, and everybody thinks their investment process is better than everybody else. And that's the great thing about it. And there are certainly some that do well through various periods of time and some that don't. Look, I think for us, the most important part of running and building a funds management business is the people. You can't underestimate that. I think working with good people, the culture in particular of the place, and how you set that at the outset is really, really critical. And also I'd throw in humility. This is an industry where it's high pressure, high risk, high reward. You'll have days and weeks and months and years where you think you're invincible. The market's going in your favour. You've had some good stock calls, and then you wake up the next day and you get smacked in the face, whether it's a profit downgrade or something like that. And so that's part of what we do. And so I would say in terms of the key ingredients for sustained outperformance, I think having the right people, the team is critical. Low turnover in staff in the investment team is obviously really important as well, and can't be underestimated. And just staying humble and trying to keep it real.
Yeah. At the time that we're recording this, we're running a series called the Undiscovered Fund series on Livewire. It's for those funds that have launched in the past 3 years. What are some of the things that you've done well, and for aspiring managers that might be in that cohort, any little potholes you can help them avoid on their journey as they rise up?
Yes, plenty. And so maybe don't launch a fund before one of the biggest share market crashes of your career.
Avoid COVID if you can.
Is one that stands out, obviously. But no, I think the feedback we've had from a lot of our investors that are very supportive of our fund, which is really pleasing, is that they tend to like the simplicity of it, being the way that we manage the money, the way we run the business, and how we communicate with people. Generally, people are very busy in life. They've got a lot on their plate. To dumb it down for someone and make it as easy as possible for someone to digest is really critical. So I think that's a really key ingredient that we've found in terms of our success in raising money in particular. A lot of people have said to us it was an easy story to understand, an easy story for them to pitch to their own clients as well. Obviously, performance is a given. You need to be able to outperform and have strong relative outperformance, given how competitive the funds management industry is and the amount of choices that people have got. And at the end of the day, they're typically investing with the individuals, and you're backing the personalities, or you're not. So I think that's really another important point to make. And also the other thing that's worked in our favour is that we had a finite capacity. So I sort of hinted at the outset that we are investors in that small cap end of town in Australia with just around $500 million under management. And at the outset, we said that we were going to target FUM was 400 million at the outset. So we said as soon as we get to 400 million, we're going to soft close to new investors. So what that did was, coming out of COVID, we were able to perform really strongly. Inflows, really lifted and accelerated quite dramatically, particularly in the early stages of 2021. And so the more we could say to people, look, some of investors we met 5 or 6 times before they actually invested in the fund. But by the time you say, well, okay, we're here now, we're soft closing, you're either in or you're out, people typically came in, which was really nice, and we're very grateful for our investors' support. So having that finite capacity, dare I say, playing the FOMO card, if you like.
Well, it's scarcity, isn't it?
Scarcity, it is. And if you look around town, in a lot of the strong performing small cap funds over time are typically closed.
Yep.
And so there's always investors looking for new options in that small cap space. And so certainly you need a bit of luck on your side too. And we certainly had that with the rally coming out of COVID, because on the 23rd of March of 2020, it certainly did not feel like the share market was going to rally the way it did in the following 12 months.
400 million probably felt like a fair way away at that point.
Dream. Yeah. Absolutely, yeah.
We're going to get into small caps, and we've talked about the past few years being shocking for small caps, and especially in the industrials part of the market that you spend a lot of your time. There's been very few IPOs. We hear about the lack of liquidity. Do you think you would have had the same success raising capital, launching the fund, if you'd done so in the past 18 months or so?
Probably not. Today it is a lot more difficult, as you said, James, to raise money. As you sort of hinted at the intro there, the last 3 to 4 years have been probably some of the toughest years that I've seen in my 20 odd years of doing this, investing in small caps. For that small cap end of the market, in the last, since we've been running the fund almost 4.5 years now, the small cap index, the small ordinaries accumulation index, has returned 3% per annum in 4.5 years. Now, if you look at the 30 years before that, before we launched the fund, it was 10% per annum. So quite a significant underperformance, quite dismal in fact. And so it's been really difficult, as you say. There's been a lack or dearth of IPOs, of secondary capital raisings. IPOs that have listed have really struggled. Selectors are more selective on deploying capital into IPOs and secondary deals that I've ever seen before. People are happy to sit on the sidelines and wait for the right deal. Like Nick Scali was one more recently that's been very successful, that raised money to enter the UK market. So that one was certainly very well supported. But certainly a lot harder to raise money today than what it was coming out of COVID in late 2020 and early 21. So we're very pleased that we've been able to perform the way we have. But as I said earlier, it's all about what the next 5 or 10 years looks like. And so we're very focused on continuing to deliver, hopefully, strong outperformance for our investors.
I was wondering if you could give me a few stories or a few examples just to illustrate how bad things got at in the small cap part of the market, because we've heard a lot of managers talk about, hey, it's been really difficult. I was just hoping you could, for listeners, just paint a picture of some of the sorts of things that you saw going on that told you, how bad it really was. Yeah,
there's a couple of examples there, James. More recently, you typically get calls from bankers that want to wall cross you on a deal, a prospective capital raising, and so...
What wall cross you?
So wall crossing. So you're being made an insider. You're in possession of our inside information. You can no longer trade or communicate to anybody on the stock once you get wall crossed, as they say. Typically, you get wall crossed, and the deal would have a 99% chance of getting away. Over the last 2 years, I'd say we've been wall crossed on, say, 30 transactions, and maybe 5 or 10 of them have got away. I've never seen the fallover rate so high with capital raisings and the lack of appetite from investors. So that's certainly one thing I think that stood out to us, is that just the struggles particularly in that end of the market. And then going back to, we like talking about the stories now we're through the COVID period. But we launched the fund, we were working from home. Martin and I were running the money. We as you know, communication is everything in this, what we do. And so, we downloaded this app called Zello on our iPhones, which were essentially a walkie-talkie. So Martin and I will be communicating, working from home on our iPhones through this walkie-talkie. So it's instantaneous communication, but you're carrying your phone around, and people would sort of look at you and say, who is that? There's something going on. Anyway, so that was a bit of fun. But this incredible period, like going through the GFC, the opportunities, and coming out of COVID was similar. I remember around mid-March, I turned to Martin. I said, "This is getting really silly now." Viva Leisure was a company that we were looking at the gyms business, and we'd looked at it before the launch of the fund. We hadn't bought a share in it, and it was trading over $2, and it looked okay to us. And mid-March came around, the share market was crashing. The share price was down at 94 cents. And so an opportunity came up to buy stock in Viva Leisure. I said to Martin, we need to be deploying money into this. This is quite extreme. And so we ended up putting 1% of the fund in Viva Leisure. 5 days later, the Prime Minister of the time, Scott Morrison, announced that all gyms across Australia were closing. Oh. The stock went into a trading halt. The business was obviously on its knees at that point. It came out of a trading halt. The stock was down, I think, 30% on resumption, down at 70 cents, and that was the bottom. And so I felt sick because Martin was umming and ahhing about, I don't know if we should buy in shares in Viva Leisure. We did that. And anyway, 6 months later, the stock was over $3.
Did you buy more when it came out of the trading halt?
We did buy a bit more, yeah. So it was actually one of those ones. And the great lesson out of that was the best time to be deploying money, and I've found this going through the GFC and coming out of COVID, is the best time to be putting money to work is when you feel sick doing it.
Yeah.
It doesn't feel like it's the right thing to do. It
doesn't happen that often though, does it?
Typically once a decade. So I've been doing this for almost 20 years, and I've had 2 of them now. Hopefully the next one's well down the track, because it's certainly a stressful period. But typically the best returns are made, as Buffett says, when there's fear on the street.
It's so easy in retrospect to look at it though, isn't it? You hope after you've been through a few, you get better at capitalising on the opportunities.
Yeah, and you see the signs, and the signs are complete panic, forced sellers, particularly in the small cap end of the market, micro cap end of the market, where funds are getting redemptions, people are selling, they want their money back. Vice versa, it was interesting to see, and it's been interesting from our fund's perspective, the experience from a redemption standpoint. The redemption activity has been incredibly small for us in our first 4.5 years, and it's been quite interesting to see the behaviour of some of our investors, and particularly there are a number of our investors through that March, April, May period of 2020 that successfully, they put in money at the start at $1, and then they put more money to work. They doubled down through that period, and it's obviously worked out quite well for them. So one of the great lessons, James, is just when you feel sick about putting money in the market and everybody's telling you it's the wrong thing to do, it's probably the right thing to do.
Yeah. Resources stocks are a big part of the small cap index, and they've actually done okay. You've talked about that difficult period. Industrials were worse. There's always a few good stories going on in the resources space, but you don't venture into that part of the market and prefer those industrials. Is that has been the case? Is that still the case? And why don't you like to kick the rocks on resources, so to speak?
Yeah, you're right. It is still the case that we don't venture into the resources space, and the main reason for that is when we set up the business, the idea was just to keep it simple and stick to the things that we thought that we were good at, and when we had an expertise or we had an edge at. And investing in resource companies didn't fit that criteria for us. We're not experts. We're not geologists. So for us, there are people out there that do that and do that well. That's not us, and that's not our core. Another thing that we excluded from our mandate is short selling. When we studied our short selling history previously, we'd been really poor at short selling. So let's take that off the table. Let's not have the temptation to short sell. So no short selling, no resources. Let's just stick to where we think we've got an edge, and that's in that small cap industrial space. And certainly that's been a quite, given our benchmark for the fund is a small ordinaries index, and 25% of that index is made up in the resources sector. If you look at the first 4.5 years since we've launched the fund, the small resources have outperformed the small industrials by 60 or 70%, the largest level of outperformance that I can remember in almost 20 years over that 3 or 4 year period. And that's primarily been driven by the tightening rate cycle, which I'm sure we'll get to. But certainly it's been a major headwind for us in terms of our relative performance. So to be able to sit where we are today, to be able to have delivered strong relative performance of 10% per annum after fees since inception is really pleasing for us.
Yep. And no temptation. You're willing to back the idea of simplicity rather than venture into the resources space.
Yeah, absolutely. And we actually had that question last week from one of our investors is, well, why don't you venture into the resources space? Why don't you hire an analyst and have that capability? It's not what we set out to do. It's not what we sold to people. We're very mindful that our investors have been incredibly supportive and continue to be so, and that's not what we sold them. So they know, and there are a lot of our investors, we over-index in terms of our number of investors in the WA market, primarily in high net worth individuals that have made a lot of money themselves investing in the resources space or running a resource company, and quite like our fund because they think that it's a good hedge in terms of, okay, well, 1851 Capital will help me manage my small cap industrial exposure, and I'll continue to do my resources stuff directly myself, where I've got experience in doing that. So
circle of competence type stuff.
A little bit, and so it's certainly it's been an interesting thing that we've noticed eventuate for us.
Last time I was on the podcast, I had Christopher Joy in. He was cautioning investors not to get too carried away with the lower rates narrative and hoping for those lower rates. And as I mentioned in the introduction, it seems to have been a prudent approach. How are you viewing the bigger picture over the next 18 months or so?
Yeah, it's a good question, James. And certainly entering the start of this year, there were a lot of people that were anticipating a large amount of interest rate cuts, and that's certainly why, in our view, you saw global equity markets rally quite strongly to be now in a new technical bull market. And a lot's changed, particularly in the last 6 weeks. There's now chat that the next move in interest rates could be higher in Australia. Remains to be seen whether that's the case. If we see a strong quarterly CPI print in Australia in July, that could be the trigger, in our view, for the RBA to push up rates again. We'll see. But over the next 2 to 3 years, where we think about our investment time horizon with the companies we're investing in today, certainly we're going to be entering a loosening cycle. Anecdotally, the companies that we're meeting with more recently, particularly in that consumer discretionary end of town, are struggling. So typically retailers, growth's anemic. All the growth that's coming in terms of profit growth for them at the moment is from cost outs, and certainly from a bit of deflation, in lines like shipping, logistics, and raw materials. But on the other side, your wages growth quite strong as well. So in terms of the bigger picture for the next 18 months, we think we are still bullish on the market. We've just entered a new technical bull market for the small cap end of the market. It's up over 20% since the lows in late October. We think that over the next 2 to 3 years, as we get rate cuts, they will come eventually, probably at a slower pace than what people had anticipated at the start of the year. That certainly will buoy markets, in particular the small industrials end of the market, which history tells you will do much better in a loosening cycle than a tightening cycle that we've been through in the last 2 years. And if you take a step back, the last 2 years we've had 13 rate hikes, the largest amount of interest rate hikes we've had since the early 1990s. We can't underestimate, the level of tightening we've had here in Australia. And to be frank, the RBA's done a pretty good job. There were a lot of skeptics around what the RBA were doing over the last 18 months, and rightfully so. But it certainly, are they going to achieve the aspiring soft landing? It looks as though we're going to get that.
Mm. So, what are some of the implications of those views? Right now things feel tenuous. Could go. Get a little tighter. Feels a little bit grind out there, but bigger picture, longer term, into a potentially greener pastures, a bit of an easing cycle. How does that flow through to your portfolio? What are some of the key positions? What are some of the big positions? How are you wanting to set yourself up?
Yeah, it's a good question, James. And one thing that we pride ourselves on is we're pure stock pickers, where we're totally benchmark unaware. And so we're always trying to find those small cap growth companies that are growing no matter what the economy's doing. And we're always able to find that through various market cycles over the last 20 years. So some of our high conviction positions in the portfolio at the moment, our biggest position in the fund is Light & Wonder. They're in the gaming space. 10 years ago, we made a lot of money out of Aristocrat. We think this is Aristocrat Mark II. They've got some very high performing games that have just been released, both here in Australia and the US more recently. A lot of the ex-management team from Aristocrat years ago have joined Light & Wonder, so a big part of our process is backing the people, backing the management team. So that's a big part of this one for us in terms of our holding in Light & Wonder. It still trades at a discount to Aristocrat. We think it's got significant market momentum and will grow at a much faster rate than the overall market in the next 3 to 5 years. So that's a really high conviction position for us. Another one is Iris. Talk about bombed out stocks. historically a market darling over many, many years in the small cap area. They've run into troubles in more recent years in the form of high debt levels and some poor performing acquisitions. Marcus Price, new CEO, previously at PEXA, successful CEO. We tend to follow them, in terms of successful individuals or CEOs in companies, and Marcus is certainly one of them. So Iris is certainly another high conviction position for us, taking costs out of the business, deleveraging, selling non-core assets, getting back to their core business, which we think is prudent from a medium to longer term. And there's been speculation in the press on and off for years around whether it'll get taken over by private equity. So remains to be seen whether or not that occurs. And the other one we'd throw in is at GQG Partners, so another funds management business.
Yeah.
It's been a good performing stock for us in the last 6 months. It still looks cheap on a P of 11. Significant outperformance over all time periods with their core flagship products. We've seen this before, being investors in Magellan in the early days and others, where good performance like that brings strong inflows for the following 12 to 18 months. So if they can execute from a sales perspective, we think that their FUM and inflows can be quite material over the next couple of years, particularly with the capacity they've got to take that on.
It's an interesting one, Chris, because if you look at the listed fund managers, a number of them are finding it really tough, and we've talked already a few times around a challenging environment for capital raising, and that extends through to fund managers. And then we've also seen this new competitor in the ETFs industry that's being there. So this is a business that's got its own independent momentum of the industry that it's operating within. Is that kind of the view there?
That's right. And I think one thing that they've done well, and people talk about funds management, is it structural or cyclical? It's probably a bit of both. What GQG have done well is they've gone to market with management fees are significantly lower.
Competitive, yeah.
Than the competitors, and so they've essentially undercut their competitors on fees. That's partly worked in their favour, but also they've delivered really strong outperformance. And so, it's quite a compelling proposition for prospective investors to invest with GQG right now. So we certainly think they're in a terrific position, over the next couple of years, and certainly will be a standout performer in that listed funds management space, we believe, for the next few years.
Yep. Late last year, as part of Livewire's Outlook series, you and I had a chat, and you said that you expected the first half to be quite tough for company earnings, but for those earnings to improve towards the second half of the year. Is that still your base case, and have you got any examples where you can start to see that coming through?
Yes is the short answer. So generally speaking, we think the August reporting season that's coming up in a few months will be tough. What's been clear is consumer sentiment at the moment remains at lows. There's a lot of uncertainty around the next movement in interest rates. The consumer has definitely pulled back in more recent months, and we can understand the reasons why. Is it still a base case that earnings will improve in the second half of the year? Yes, it is, but not to the same extent. At the start of the year, if we were going to see rate cuts, that would certainly stimulate the economy, and particularly the consumer, and we just can't see a rate cut occurring this calendar year. I think that the markets are pricing in the first rate cut to be in the later stages now of 2025 calendar year. So remains to be seen whether that plays out. Our sense is it could be a bit earlier than that. So we do believe that earnings will pick up in the second half, but no longer to the extent that we thought, just given that interest rate outlook has changed in more recent months, and in rate cuts have been pushed down the road probably for another 6 to 12 months.
Yep. Now, I know it's only day one, and the Macquarie Conference would have wrapped up by the time this podcast goes live, but you've wandered down here from that conference. What was some of the messages that you were hearing, or some of the common themes that you caught from the presentations you caught? Yeah,
so I sat through a few presentations this morning. What I would say is record attendance. There's certainly a lot of people there, probably the most I can remember at a Macquarie Conference in a very long time. Sat through some of the property presentations this morning. So general feedback is that from a residential standpoint, Western Australia and Southeast Queensland are the two bright areas of the housing market around the country right now, and are certainly flying and really performing quite strongly from a price growth perspective. On the flip side, Victoria remains quite weak, and oversupply of housing, new property taxes, state government budget comes out today. Let's see what they say. But Victoria is certainly struggling, and is certainly the poorest performing state right now from an economic perspective. Generally, property companies, where they're talking about office and retail, sentiment remains quite poor. You're still seeing transactions at discounts to NTA. Likely you see NTA downgrades coming through at 30 June coming up again for some more than others. And then you've got to sort of tip your head to, okay, what does this mean for balance sheets and for gearing levels? Do some of these companies need to raise equity? The answer is yes, if they can't sell assets to fix their balance sheet. So there'll be some good opportunities in the REIT space, we think, over the next 6 to 12 months and as we get into that loosening cycle. And so never seen sentiment this bad in the micro cap end of the market, but also in the REIT space in 20 years. So there's going to be some great buying opportunities there, we believe, in the next 6 months. But generally, feedback from the conference so far, and it is early days, is that the consumer remains tough. Growth is hard, and typically companies are achieving growth from cost outs right now, as opposed to top line growth.
You mentioned things stay tough in the micro cap end of the market. We had a few of our readers asking, could you speak to some of the fund managers around some of these really bombed out stocks that are being unloved, overlooked? They often hear people talk about companies that are, kind of bucking the trend and doing well. You got an example of something that, does pass the 1851 filters, but is really bombed out and unloved?
Yeah, I do. There's a few. One of them's we've held since the inception of the fund. It's been a poor performer in a relative sense. Is Capital Health. Mm-hmm. So it's a little radiology business. It's in our top 5 holdings. Is it bombed out? I would say yes. Back at 24 cents, it hit a peak of 40 cents only a couple of years ago. Look, it's a turnaround story. New management under Justin Walter have done a great job going in there a few years ago now.
I feel like Capital Health might have had a few turnarounds. Has it had?
This is probably the third or fourth.
Gone through a few corners over the years.
It has, unfortunately, but I think they've finally got it right. Justin's done a great job turning the business around, keeping the radiologists happy is probably the key to the business. Fix the balance sheet, successfully executing on acquisitions. Look, it trades on its valuation is 7 times EV to EBITDA, enterprise value to EBITDA. You've seen other radiology type businesses in the last 2 to 3 years transact from a takeover perspective at 12 to 14 times. So this one's been forgotten about. It's languishing at about that $250, $300 million market cap level. So it's at the cusp of, you're kind of not relevant right now, but you're about to be from a size perspective.
Yeah.
So that's certainly one that's, we continue to hold. We're a substantial shareholder in the company, full disclosure. We think that they're doing a great job. Right now in the short term, they put out a really strong result back in February for the half year. Since then, we've seen Medicare stats in their primary markets being Victoria and Western Australia being quite strong. So based on that, if they are seeing that reflect in their own volumes, which they should be, all the scene's been set for them to produce what should be quite a strong set of results, hopefully, coming up for this full year result period.
Okay. I guess the flip side to bombed out stocks that can turn around is bombed out stocks that stay bombed out, or high flyers that become bombed out.
Yeah.
We often hear small cap managers talk about the importance of identifying red flags. We hear about aligned management, the things you like. Could you bring a few examples of where these red flags have shown up so people can kind of visualise what they look like?
It's a great question, James, and we see a lot of red flags. We've met a lot of interesting characters over the years, good and bad. And one key red flag that we would have talked about before, James, is when you see insiders selling. So whether it's management or the board of a company selling shares, I would say over time, 85 to 90% of the time, you want to be going with them. So if they're selling, you want to be selling at the same time. And it doesn't always work. The one example I'd give you that didn't work in that sense was years ago. Blackmore's, the vitamin business. Marcus Blackmore was the founder.
He's got a famous announcement, wasn't it, to buy a new yacht? He sold his shares.
He did, and we bought those shares. And so it was going against, as I said, you want to invest when you feel sick doing it. When we bought those shares, I'm like, we're going against our process here. We're buying off an insider. We shouldn't be doing this. He's selling for a reason. And then 2 days later, I think he announced that he was buying shares to buy a yacht. So that made us feel a bit better. And we bought them at $47, and a year later, they went up to $200 on the back of that whole Daigou trade, people buying vitamins here domestically and shipping them to China primarily. So that was one example that went against the grain, but primarily, and most of the time we've witnessed that, and this goes for when they're buying as well, you typically want to be buying with them. But when they're selling, and you get all the usual excuses, don't you? I'm selling, I've got a tax bill, or I was the divorce, or I'm buying a house, and we've seen a lot of the excuses over these, and they typically are the same. The more recent examples that are quite topical right now, where you've seen a high level of insider selling in the last 6 to 12 months, are Kogan and Satire, and those are two stocks that are polarising people right now with high levels of short interests in those particular names. So that's certainly one red flag that I'd call out, is typically you want to follow the insiders when they're buying or selling. And the second red flag is beware of the long-term successful CEO that departs a company. That's one that's played out again. We've witnessed over time to a T where, again, market darling, and Iris I'd throw into this bucket as well, where you had Peter Dunai, who ran that company as CEO for a very long time, very, very well. And then when he left the business, it was never the same. And the one more recent example, which some of your listeners might be following right now, is Bapcor. So this week they announced a terrible profit downgrade. The shares, I think, were down 20 or 30% on the day. Darryl Abotomy was the previous CEO. Again, was a market darling stock. He performed quite well. After listing, you couldn't fault the company. It performed quite strongly. Now, Darryl left a couple of years ago, and now I think you're starting to see a bit of the pain of that change in management. Change in management brings change in culture. Typically what we find is when the leader of a company leaves, it's not just the individual, it's probably a team of people below them that never gets spoken about, who are typically the most important people in the business that are actually running the divisional parts. So that's certainly one at the moment, and that's another red flag, is beware of the highly successful long-term CEO when they depart, and what's left for them after that.
We do have 3 regular questions. You would have answered similar style questions last time you're on the podcast. We've tweaked them a bit, so they are a little fresh. So we're going to get into our 3 regular questions. The first one, can you start by sharing a story from a big win or a big loss? What happened and what did you learn?
Well, James, I'm going to talk about a big loss because fund managers are great at telling you how good they are and how much money they've made on a stock. Fund managers, we're human. We make mistakes every day. One mistake that we've made more recently is an investment in a company called Frontier Digital Ventures. So that one was an interesting one. Frontier Digital Investors, for the listeners who don't know, is I'd say it's the realestate.com and car sales for emerging markets. So run by a really high quality individual, Sean DeGorio, who ran a business called iProperty. Yep. It was listed years ago. Realestate.com bought it. Sean decided to start FDV, Frontier Digital. We thought, fantastic. Sean was, we back Sean at iProperty. We'll back him again at FDV. And what we typically say is lightning typically doesn't strike twice. It's very, very difficult. So as I said, you typically like backing the individuals, and like in the case of Iris at the moment, Marcus Price, but it's never a guaranteed thing that if you've had a successful CEO somewhere else, they're going to do it again at another company. It typically does. Odds are in your favour, but in this case, it didn't work and hasn't worked, unfortunately. And what we've learned is just the geopolitical risk. Obviously, we went in with eyes wide open. Their primary asset was in Pakistan. Sean and the company can't control what goes on in Pakistan, and there's been a lot of political unrest in that market over more recent years. They've struggled coming out of COVID. I think the lesson is just be more aware of the uncontrollables. Yep. In that case,
how painful was it?
Oh, very painful. We halved out. We lost 50% of our money, investors' money. So we feel sick about that. And we've since exited the position, which probably means it goes up from here. But
that's not advice, people.
No, but it certainly isn't. But so look, and so I think Sean's a high quality operator who will continue to do well. But it's just going into the business and just being more aware of what those uncontrollables are. Because some of the best CEOs in the world just can't navigate through certain things like that have occurred and been thrown at FTV.
Yep. Chris, what do you think investors are overlooking or have wrong about markets right now?
James, the one thing I'd call out here is we're only 12 months away from the next federal election. And we remember going back, Anthony Albanese was successful at the last election, quite strong majority. Now, people are just expecting, the consensus in markets is that people are expecting that Labor are going to win a second term. And if you look at the odds, going back over 100 years, typically a government doesn't get thrown out after one term. We think that there is certainly a risk to Labor winning government again, and particularly getting another majority. And what that's got quite large implications for equity markets across a number of different sectors that we study. So I think that people are it's only 12 months away. People are quite dismissive. I think, Labor will win again. We don't think that's the case. We think the election will be a lot closer than what people anticipate. And so I don't know if Labor will achieve an actual majority. So it makes it hard to govern the country, as we'd seen over the last decade with some of those Liberal minority governments. So, has implications, things like healthcare, NBN. So they're two key sectors that we invest in small caps, and would certainly be impacted with a change of government. But it remains to be seen. But I think that's one thing that people are dismissing, or it's sort of a counter-consensus view, if you like, as we approach that period. Obviously, we've got the US elections coming up in November, and I don't like following the bookies. If you look at how they've predicted elections in the last 5 or 10 years, they've generally been poor at it. Right now, they've got Joe Biden and Donald Trump for the next US president being fairly even in terms of who's going to be successful there. So that's probably another, from a political standpoint, because we're probably in one of the most uncertain geopolitical environments I can remember in my lifetime right now, and it doesn't look like that's going to change anytime soon. So quite critical in terms of some of those elections coming up over the next 6 to 12 months.
You talked about people backing in another Labor win having a knock-on effect to healthcare and the NBN. Would a Liberal victory, do you think it would be, are you saying it would be positive or negative for the sector, for those sectors?
Hard to say, because they haven't really, Peter Dutton hasn't really talked about what his potential policies would be in those particular sectors. Typically, Labor governments spend more, don't they? So we're going to find out in a couple of weeks' time from the next budget through Treasurer Jim Chalmers in terms of the areas of spending that are coming up for the next few years. But generally speaking, it's probably a negative for the NBN sector. I think Labor are more pro, investing in the fibre to the home, particularly at the moment. So it's throwing more money at it. From a healthcare perspective, probably neutral, I think. Yep. It's just one thing that's could really sidestep investors over the next 12 months if we do see a change of government, in our view.
Our final question is one where you actually did answer it the last time you're on the podcast, and it's a hypothetical question. We're not recommending people go and buy a single stock, but if markets were to close tomorrow for 5 years and you could only own shares in one company, which one would it be and why? And before you give me your answer for today, I thought I'd bring up the performance of your last pick, which was NextDC, and the share price is up 77% since you're on the show. So all we're asking is that you just try and do a bit better than that on this pick. And
well, it probably means this one will be a dud. Odds are, if that one's been a good one, the next one won't be any good, but we'll see.
Do you still own NextDC? Do you own it in the portfolio?
No, we don't. It's in there. It's now entered the ASX 100. So
outside universe.
Again, I'd still say it looks in a great position, NextDC, from that data center thematic, which only continues to gather momentum since we last spoke a few years ago. But the one stock that I would mention today, which I'd put in that bucket, James, is TUAS. TUA is the ticker. For those of you who follow the telecommunications sector where they operate, TPG Telecom has been one of the most successful performing investments on the Australian market. If you go back over the last 10 or 20 years, led by David Teo, its founder David Teo. TUA was spun out of TPG when they did the Vodafone deal. And what you've got now is essentially, to us, this is TPG Mark II. So I talked about Light and Wonder being Aristocrat Mark II. To us, this is TPG Mark II, where you've got David Teo. Now, TUAS are primarily a telecommunications operator in the Singapore market, both broadband and mobile. They're going in with the same strategy that they did in Australia, which was to undercut the competition on price. And they did it quite successfully, as we know, in Australia over many years, undercutted Telstra and Optus in particular, and Vodafone to a lesser extent, and grabbed market share and turned out to be the fastest growing telecommunications business in the last 10 years. We think that they're now doing that exact same thing in the Singaporean market. It's essentially using the same playbook, haven't they, to execute in that Singaporean market. And for us, it carries a lot of characteristics that we look for in a new investment. And people say, what does the ideal 1851 stock look like for you? And some of the key characteristics that we would put in that bucket are obviously management alignment. In this case, obviously David Teo is the major shareholder. A low level of institutional ownership on the share register. So typically, explain it this way. If we're competing with 100 different fund managers, let's say in the example of Tuas that 90 of our competitors already own the stock and 10 don't, so you've got 90 marginal sellers of the stock and 10 marginal buyers. It's quite simple logic, but typically you want to be the first fund to buy the stock when there's no other funds on the register, and typically that's what we've seen over the years is that takes the share price higher over time. So TUA right now has got a relatively low level of institutional ownership in our opinion. It hasn't quite gone through that cycle, so we think that's a strong positive. Good cash flow generation with a clear niche and competitive advantage in that Singaporean market, and backing proven operators. I think is really important to call out here. David has done, and his team have done a terrific job at TPG over many years, and we're backing them to do the same here again at Tuas. So a good small cap company, market cap of north of 2 billion now. It's had a strong run in the last 12 to 18 months in particular, but 5 to 10 year view, we think that the stock can be materially higher from here. So it's right now it remains a core holding for us in the fund at 18.51.
Great. Well, that's awesome, Chris. Before we wrap things up, because we've talked a lot about investing, setting up your business, things that you're passionate about. What about outside of 1851 Capital? How are things going?
Great.
You
so
keeping busy?
2 young kids that keep me very busy. They're growing up quickly. So Edward and Abby, they are 12 and 10 now this year. So certainly, really enjoy spending time with the children. Obviously, and also I think it's important to have balance in life. And one of the things that I'd learnt that over the last decade is to have that. And so in terms of my buckets, there's primarily my major bucket is obviously 1851 Capital, where I spend the vast majority of my time in terms of helping run the business and run the portfolio, but also giving a bit back to society. So 5 years ago, I joined the board of the Sydney Swans Foundation, where I sit there as deputy chair. So big Sydney Swans fan, and fingers crossed 2024 is the year of the Swans, and so far so good. We're top of the ladder, so another premiership would be nice this year. But certainly the foundation does great work in terms of giving back to the community through the Swans Academy and the like, and also do a bit of work with the Children's Hospital out there at Westmead. That's certainly an area of passion to us, and something where there are areas out there that are grossly underfunded, and so the more we can do to help, the better out there. And so they're certainly my buckets, if you like, James, in terms of where I spend my time, with 1851 being the major focus. But I think it's really important to have that balance in life and to give back to the community. So I've tried to find that right balance.
Sounds like you're still enjoying it.
Love it. Yeah, look, funds management, we're very privileged to do what we do, and to have it. We've got 1,000 investors that entrust us, with a substantial part of their personal wealth, and so that is a privilege to be able to do that. It's a privilege to speak with the various CEOs and CFOs and learn about what makes them tick and what makes those individual companies tick. So you never underestimate that. Always keep a level head and feet on the ground, and just look forward.
Okay, great. Well, Chris, thanks so much for coming in. It's been great to catch up again. For all of you listeners out there or viewers, that wraps up this episode. Coming up next week, we've got Ali Selby, who's going to be speaking with Katrina Burns, who's the lead portfolio manager for WAM Global. Katrina's been spending a lot of time overseas in New York, so I'm sure she's going to have plenty of great insights to share with you, so don't forget to tune into that episode. And just remember, if you aren't a subscriber, hit subscribe on your podcast player so you can stay up to date with all of the cracking interviews we've got coming your way. But thanks again, Chris. It's been great to see you.
Really enjoyed it, James. Thanks very much for having me again.
I should give you a little souvenir of a little 10 years ago. I can sign that one for you.
No, that's awesome. Let's frame that in the office.
Great. Well, thanks again, folks, and thanks for listening.